Alright guys, today, chapter 3, financial statements. So, chapter 1 and chapter 2 were introduction to financial economics. Now, chapter 3 and chapter 4 are introduction to financial accounting. Chapter 3 is financial statements and chapter 4 is financial statement analysis. So these two chapters go together. The second one goes after the first. And probably my plan is to cover 3, to cover 4, and then we'll go for about a week or more in exercise. Just solve problems, maybe build statements, financial statements, and analyze. All right, so what do we have? Number 1. So section 3.1. Overview of financial statements is fairly straightforward. You have 4 major financial statements. Number 1, income statement. Income statement gives you all the revenues and all the expenses for a given period of time, and the gross and net income. The net income is better and popularly known as profit. Profit. Number 2, balance sheet. The balance sheet gives you the financial position. The financial position of the company is associated with its assets, its liabilities, and owner's equity. It tells you what assets the company has and how these assets were financed. How much of it was debt, what type of debt, and how much of it was owner's equity. Is it investments? Number 3, remarkably important, is the cash flow statement. It tells you all the sources and uses of cash flow. The sources of cash flow we call cash inflow, and the uses of cash is called cash outflow. And at the end of the day, at the end of the period, what matters to a business is how much cash they generated. Alright? And then it's important to understand the difference between cash and profit. There are companies that generate a lot of profit but have very little cash. And its opposite is possible. You can generate a lot of cash with little profit. You need to be able to reconcile where the difference is coming from. Is it because the business had something extraordinary, or because the business was profitable. You want to see a business that generates a lot of profits and a lot of cash at the same time. And of course, you always want to know where the cash is going. All right. And the last one is called statement of shareholder equity. Shareholder equity is the capital of investors. And it tells you all the major transactions associated with equity, like profits, like dividends. So equity is usually old equity, and you add your profits, you subtract your dividends. So it tells you what happened to the owners. If you're an owner, this is a relatively important one. For financial statement analysis, this is not very important. And therefore, the focus is on the first three. These three are more important from financial statement analysis point of view. So, this is overview. Now, benefits. What are the benefits? This overview, this tells you basically the question of what do we have, or which are the statements. The benefits here are why we do this thing. Number one, analysis, financial statement. The main benefit is you actually analyze to find out what is going on, to find out what's right, to find out what's going wrong. You want to identify potential strength, but especially you want to identify potential weaknesses. So basically, you take a look and see what's right and what's wrong. Number two, financial control. Financial control is watching how you spend your money. Financial control is watching and be careful about wasting money, okay? It is amazing. I have worked and teaching in the Arab world that most businessmen over there don't understand the concept of wasting money. They don't understand the concept that if you're spending money left and right, this is money you don't have for your own profit, okay? That also happens a lot here in Asia. In general, most people don't understand that financial control is probably the most important part in business profitability. They just spend money here and there, and at the end of the month, they don't have money in the sense of don't have cash available and don't have profit. Well, the trick is not to spend the money. The trick is to spend as little, have as little expenses as possible, and as much as revenue and maximum amount of profit. So, a very important part of financial control is just a separate piece, which I explained so far, called cost control. Cost control. If you're in business, you want to control the cost. You've got to watch where you spend your money, how you spend it, if there is a waste. Let's see what else we got. Of course, the second part is monitoring. You want to monitor your business. And The last part here is, let's see, performance measurement, but it's also the same thing as performance evaluation. You want to evaluate the performance, and you may be evaluating the performance of production, of sales, of whatever it might be. And potentially how to design or what kind of bonuses you will pay. Executive compensation. Financial control, that's number 2. And number 3 is financial forecasting. You actually want to see where you think you might be in the future. Part of financial forecasting is a tiny little piece called budgeting. Budgeting is the process of creating a financial plan. So budget is exactly the same as financial plan. Part of the financial plan is to evaluate as you expect to run your business and as you expect possibly to make investments, buy machine, buy equipment, are you going to have enough cash? So you need to forecast your cash. So you will need to forecast your income statement, and then you need to forecast your cash flow statement. And if you will run out of cash, or mean you will need extra cash, you'll need to know how much you think you will need and how you're going to get it. Are you going to arrange for a loan or securities or cut some other expenditure? Basically, you need to have a financial plan. It's called financial gain. Now let's see what else you got. Well, that's it. Next one. Next one, benefits. The next part is accounting. Let's see how many we got. Accounting principles. Accounting is guided by principles. Principles in this particular case means rules. Rules that you typically follow. Rules that guide you to do the right thing. So there are a number, 6 or 7 accounting principles. Here, for summary, we have only 3. The first one is called the revenue recognition principle. I can put it in red, it doesn't matter. Revenue recognition. I put this little dash here, is the same as principle. So, revenue recognition principle. Sometimes just revenue recognition. It's very simple. You recognize revenue when you earn it, when you actually make it. It basically means after you deliver the product or after you deliver the service. So you first deliver the service. When the service is complete, then you recognize revenue. Exception. All right, where's the attendance sheet? The attendance sheet. Where's the attendance sheet? All right, that's good enough. Mark these guys. Well, what happened? Why didn't sign? Get these guys late so that next time they'll learn. We'll get late for next time. We'll know and learn. It's a learning process. That's why students hate it, right? Nothing wrong with that. All right, let's mark those people here. All right, now you can pass back and sign. So revenue recognition basically means you guys on the back sit back on the front, the late guys sit in the first rows. You know, I'm getting tired of students coming late and always going on the back and then talk. So whoever were the late guys up front there. All right, it's unfortunate I got to deal with stuff like this. Yeah, and there's one front desk over here. Yeah, the second one is free and available. All right, so recognition, revenue recognition means you cannot record revenue until you actually earn it. The key word is earn. Earning means two things. Earning means you made it, if it's a service or a product. And number two, you delivered it or gave it to the customer. So, if it's education, let's say for you guys, you already pay your tuition. Your tuition is not a revenue, okay? It's a prepaid expense, okay? It becomes revenue only after the education service is complete. Now, if you got a period of time, let's say the service goes over 4 months, at the end of the first month, we can recognize 25% of the revenue because only 25% of the semester of the school was delivered, okay? Same thing applies for patients in a hospital. There may be 2 or 3 consecutive procedures that must be required, and in general, only after it was delivered or completed, not before. Just because you expect something to happen, you don't record revenue because you like it, you want it, or you hope for it. You record it after it's getting done. Number 2, matching principle. Matching principle is associated with costs. These costs we call expenses. In a month, we record expenses that are associated with earning the revenue. So when we say matching principle, you have to match expenses, you match them to the revenues. So you recognize only those expenses that you used to generate the revenue. If you did not use the expense to generate the revenue, it's not a true, real, genuine expense. Something else happens. For example, you had a truck, you used the truck for a while, at the end of the, or at some point, you sold the truck. You can record possibly a little profit on the truck. You can record a loss. The profit, again, notice how we say the word profit is incorrect. It will be, it's called a gain, okay? Or if you sell it at a lower price, it will be a loss. But just selling the truck, if it's not your main line of business, is not associated with generating revenue. So the key is, did we use the expense? Did the expense help generate regular revenue or did not help generate regular revenue? Okay? And of course there will be a lot more to talk about, at least for the next week or so. But the principle is expense must match revenue. Historical cost principle, again, just historical cost. You record assets at their historical cost. Historical cost is the cost that you actually incur. If you spend $20, it is $20. If you spend $25,000, it's $25,000. Historical cost means you don't record what you want, or what you like, or what you think. You have to record of exactly what happened. And with a historical cost, especially for major assets like a video camera or computer or some other equipment, or in general assets, you need to have a document. We usually call a receipt, a document which shows and proves the cost itself. Okay? So when you're showing your accounting, oh, you made a cost of, let's say, $300 for a camera. Well, where's the receipt? And the receipt must match the accounting. So historical cost requires that you put in what you actually spent. And even though, for example, you may have a house, you have a real estate building, you may have a, let's call it office, the price of the office can go possibly up. But you can't record the higher value of the house. You keep it at historical cost. Now, we've studied, and it's not required for this course, this could be an exception only for certain securities. You have stocks or bonds or gold or other highly liquid investments. You may use, instead of the historical cost, the current cost, okay? And sometimes you have a very special procedure for financial institutions like commercial banks, investment banks, and whatnot, called mark-to-market. And mark-to-market means that you record the asset at today's price. If you have gold, you can mark it to market. You have silver, you have other highly liquid, exchange-traded assets. You record it at market. You update to the price of the asset to the market. But for all others, and that will be more than 99.9% of businesses and assets, it will be simple historical cost. And the historical cost will not change until you get rid of the asset. If it's a long-term asset, you may start accumulating depreciation, but the historical cost will remain the same until you scrap the asset, okay, or possibly the liability. All right, let's see if there's anything. Well, that's it. This is section number 1. Now moving on to section number 2. So 3.2 is, again, we're going through the statements, the primary, the main statements. So 3.2 will be income statement. In general, when you do accounting, as we'll do exercises possibly, you always do them in certain order. The first statement of all 4 always to do is the income statement. Anybody? Which is the second statement? The second statement is the shareholder equity. You cannot do the balance sheet before you do first the shareholder equity. You need the shareholder equity number to get the balance sheet. Now, you can possibly do the balance sheet as number 3, or you can do first the cash flow statement and then also use the cash out of the cash flow statement to build the balance sheet. Anyway, income statement is always the first one. You get the revenues. Basically has 2 major parts, revenues and expenses. It's usually very confusing for students in general, even for professionals, to make the difference between an expense and a cost. Cost is something where you spend money. Expenses where you spend money to generate revenue, because you might be spending money on other things which don't generate revenue. So the income statement is associated with expenses to generate the revenue. This is associated with the matching principle, so expenses must be used to generate the revenues, and the difference is just that. It's called, technically in accounting, net income, but is popularly known as profit. Now, the word which we don't know exactly what it means and that should not be used is the word is income. We don't know what income means. People like a lot to talk about income, but it's very, very unclear. Some people use it to mean profit, some people use it to mean revenue. Income means 100 different things to different people. In general, it's coming in, but exactly what's coming in is not clear. So income is a word that you shouldn't be using in finance, just like bank. It's not exactly quite clear what bank means. We know exactly what's an investment bank. We know exactly what's a commercial bank. There are other like savings bank, but just bank is very unclear to it. And income is just the same. All right, so you have a number of, we call these now elements. Which are the elements or which are the components of an income statement? Well, let's see. Sometimes revenues is called sales. In accounting, sales and revenues is exactly the same. There is no difference. And a lot of times you just call it sales. So that's fairly straightforward. There is the next piece. Again, all I'm doing here is you guys should be having a textbook. And for the textbook, you should be having, so you can actually follow what's going on. Maybe I'll have next time PowerPoint where I can just show you. But number one, you have already studied this. This should be perfectly familiar to all of you. You should have done dozens and dozens of exercises. That's what a whole course in financial accounting is. Why are you looking like you've never seen this before? You should be perfectly familiar. You should all know it. Now is not the time to learn it. All I'm doing right now is a review of your financial accounting course. You should have studied this for full 15 weeks, okay? This is just a quick review. The next one is called financial mathematics, which we'll study in chapters 5 and 6, which you've studied in mathematics. And I'll review quickly over a week or 2 weeks. And again, I'm going to do exercises for a week or 2 weeks, okay? So most of this stuff should be perfectly familiar. So, what's the next piece? The next piece is called cost of goods sold. Cost of goods sold is your cost, your manufacturing cost, your acquisition cost of whatever you sold. If you're selling cameras, it's cameras. If you're selling food, the cost of your food, okay? If you're selling tables, the cost of the tables. If you're selling cars, cost of cars, okay? So cost of goods sold. If you are selling some kind of a product. Usually, almost everything in business, a sale is associated either with a good, which stands for a product, or with a service. And that's it. And with services, it's actually easy. With services, you don't even have a cost of goods sold, like this university. Yes, the university has a number of expenses, but pretty much not cost of goods sold. Maybe they sell you, maybe not, a textbook. And maybe they acquire the textbook at 18 and sell it at 20. Now, I'm not even saying that the university is trying to make a profit out of it. I'm saying is that occasionally, when you get a service, for example, you go at the hospital and they have to give you a painkiller. Another classic example of selling a product while during the service is you go to a dentist, and the dentist will give you, it's called anesthesia, a painkiller, so that while he's working and drilling your tooth, you don't feel pain. The service is the labor of the doctor and the dentist with all the other stuff. But the painkiller, he probably acquired, I'm just making up numbers, the cost of $15, and he will charge you $20. Okay? Just like for the textbook. It's, let's say, $18 how they got it, acquisition, and they sold it at 20. This is for services. Service is a little trickier, but at the same time, services are a lot easier. Okay? And with goods, it's a lot more complicated, but it's, at the end of the day, as simple as that. Usually in accounting, you'll have a separate little statement of how you calculate the cost of goods sold. It's done typically in managerial accounting. That's what managerial accounting is. How we calculate the cost of goods sold. Most of the times you'll be given 2 or 3 components of the cost, okay? Or you're just going to be given, this is the cost of goods sold. Again, when you're buying a camera, and reselling a camera, you know, oh, I bought my iPhone for $5,000 and I'm selling it for $6,000. Or $500 and I'm selling it for $600. It's typically, the number is well known. Now, here's another confusing term. That's why it's very important to know these and to use them correctly. When you get sales minus cost of goods sold, you get a new number called gross profit. And a lot of times it's confusing, again, because you got for the same thing a lot of different words. Sometimes we call this gross income. Gross income is pretty much the same as gross profit. Okay? So, very confusing. So, gross profit is the difference between your revenue and the cost of goods sold. Okay? Sometimes they call it gross margin, but the word margin is associated with percentages on a per dollar basis. But a businessman might think like that, and it's correct. Oh, I'm selling an iPhone for $700. The cost of the iPhone is $500. So my gross margin is $200. But we like to think in finance in terms of percentages, whatever is $200 out of $700. Okay? So that's the gross profit. Next, you get a whole bunch of expenses. And these expenses, now I'm going to switch a little bit colors. We call, well, I'll write them out there. Operating expenses. Operating expenses. So, you have a lot of stuff. You gotta move the camera, right? Operating expenses. The key word is Operating. Operating means normal, regular, usual, typical things that you gotta do to generate business, to generate a sale. The classic example, let's say in teaching and education, we have operating expenses. And a simple operating expenses, the marker. We typically write. We got some expenses associated with the markers. Where's the attendance sheet? Where's the attendance sheet? Let's bring it in here. I had to print it earlier this morning, like 10 minutes before class. I print the attendance sheet. Well, that's a simple expense. Yeah, one piece of paper and some printer. Okay, that's a typical operating expense. Another operating expense will be, hey, yeah, right there, the air conditioning. All right, no, don't worry. Don't worry. Air conditioning, it's the cost of air conditioning, the cost of electricity. Okay, these are all expenses associated with the normal process of, it's kind of like hard to run the business without basic electricity associated, without, in this climate and environment, without air conditioning. So, how do we, some examples will be selling expense. Whether you sell a product or a services, you have expenses associated with the sale. You got a salesman or a saleswoman. They sometimes may be getting commissions, or they may be just on a simple salary. Whatever is your cost associated with the sale. Okay. Number two is usually put in one category. The category is called general. And I'll write it underneath, administrative. These two are together one item. And of course, becomes expense. So we have administrative expenses. Let's say the CEO, okay? He has a secretary. A simple administrative expense will be a receptionist, okay? The receptionist itself is not associated with particular selling, okay? And the receptionist is not associated with the main line of business, like the dentist. So the dentist will do the work, but let's say the receptionist will do all sorts of stuff, okay? Well, that will be administrative staff, okay? Administrative in the university might be even more, general will be the library, okay? That's a fairly straightforward expense, okay? They may change the board or whatever. So there are simple things that you just gotta keep spending money on to keep the business up and running. So that's general and administrative. Number three is depreciation. And amortization. Again, same category, expense. Remember, these are operating expenses, so each of these is an expense, expense. So what's the difference between depreciation and amortization? We did it or we didn't do it? In financial economics, Mark. What's the difference? Anybody?
It depends on the asset. The depreciation is about a tangible asset and amortization is intangible.
Whoa, okay, someone did an excellent job. Is this a bonus point?
Maybe.
Yeah, why not? It depends. I'll repeat it nice and clear for everybody to refresh your memory. Depends on the type of asset. If the asset is tangible, it has a depreciation. If the asset is intangible, like patents, okay, intangible, it has an amortization, okay. Usually we depreciate long-term tangible assets. Long-term tangible assets like machines, equipment. Simple example will be a laptop. You expect it to last 5 years. I'm just making the example. Car, a taxi. If you're driving a taxi, you expect the taxi to use it for 5 years and then throw away or have a little bit of a salvage value. You would be depreciating long-term assets. Okay, you will be depreciating machines. You'll be depreciating equipment. You may use it longer term. If it's dirt cheap, let's say less than $10 or $100, you don't have to depreciate it if it's a small amount. Okay, if it's $5 or $10, you don't bother depreciating. You just expense it all. Okay, but depreciation expense is for some businesses with a lot of machines and equipment, is a major expense. What else we got? Total, okay, well, these three will give you total operating expense. So gross profit, you will minus, so this becomes a little minus here. This becomes a little minus here. Operating expense. Let's see what else we got now. Well, once you get the operating expense, so out of the gross profit, you get the operating expense out, becomes net operating income. Net operating income. Again, notice you can't just say net income. Net income is completely different. Net income is after you have subtracted all expenses. This is net operating income, which means after you have subtracted operating expenses and the cost of goods sold. Okay? So what's next? Well, next is interest expense. Interest expense. So interest, okay, net operating income, let's write here in blue, is sometimes known as EBIT. This is earnings before income and taxes. When I say earnings, let me see where I write profit. Okay, so back here, guys, pay attention now. In business, in finance, sometimes profit is the same as, when I wrote net income is the same as earnings. Very often, they call it earnings statement. And when you hear TV, and financial news like CNBC and Bloomberg, they may use the word, and it's we just finished. It's called earnings season. Earnings season is about 1 month out of a quarter where companies will report their earnings. Sorry, this is plural. That's important. Earnings season, where companies report their earnings. So during earnings season, you have in one day 10, 20, 50, 100 companies reporting their earnings. When they say earnings, they definitely mean net income. So earnings is the same as net income, is the same as profit. It's just another word in finance which makes finance relatively confusing. So this thing here, EBIT, is earnings before income and taxes. Now you take out the interest and becomes earnings before taxes. Call this earnings before taxes. Then you take the taxes out. So you subtract income taxes, and you just get earnings before taxes. You get earnings, and earnings we simply call net income. Well, this we call multi-step or multiple step income statement. Let's see what else I got. So we are finishing for today with this section. Alright, interest expense has two words. Let's go back. One is called financing cost. Financing cost. Financing cost is interest expenses. We call them payments associated with financing the business. Financing the business usually is in the form of borrowing. Borrowing is in the form of debt. And the cost of borrowing and the cost of debt is called interest. The interest that you pay for the current period is called interest expense. Okay? So this is interest expense is the cost of financing, which is the same as financing cost. Let's see what else I got to complete for today. Okay. Net income. All right. So this net income, a company will have. Okay, I'll switch back. Draw the line. Net income is the same as earnings. For a company, earnings are profits. You want to know as an investor, if you have 100 shares, what are the earnings per share? Earnings per share. Okay. We shorten it EPS. And EPS is a very easy to calculate number. It's simply earnings for which you will write net income and divided by shares, as in number of shares. Sometimes you say number of outstanding shares or number of total shares. That's a little confusing. I don't want to get it. This is earnings per share. And now we come to the next piece, which usually is poorly understood, which I'll maybe begin to explain next time. You have the income statement, and you have a balance sheet. On Wall Street, that's typically BS. It's mostly full of lies, you know. That's how they make BS, is balance sheet, okay? So the question is, what connects the income statement to the balance sheet? What is the connection? Kind of like, but not quite. Not quite. Kind of like, not exactly. What connects the income statement to the balance sheet? Something in the balance sheet must be added and put in there to make it balance. Something coming out of the income statement and in between. And I'll continue next slide, right? The answer. Retained earnings. Retained earnings. So the connection is profit after dividends. So it's not the profit, it's the profit after dividends. That's called retained earnings, is what connects the income statement to the balance sheet to make sure that the balance sheet always balances. Well, that's good enough. Thank you.